So we'll be talking about business valuation. It's also a very important topic that we need to look out for. And that is why I'm not telling you to go and read it. Yes, though I saw some messages on the group. Let me go back to the group. That there are some things I discussed in my earlier videos that they need the video. So I decided not to post the video because I want to discuss it in this class real time. Yes, and that is why I didn't respond to that message. Um, business valuation. Business valuation. Look at the word individually. Business valuation, because you must understand why business valuation. So, as you see question, you know what to do part time. But by the time you are just having a vague mind about the concept of business valuation, when you see question, you will not know what to do part time. So when you say business valuation, what are we saying? What are we referring to? And the question is, why business valuation? Why business valuation? So I'll start by saying that business valuation is the process of determining the economic worth of a company or business. If you want to know what the worth of a business is, you do a valuation. You value the business. If you have a business of, let's say, that is worth 10 million naira, before you can know that it is worth 10 million naira, there are certain accounting valuations that you have to put to test as it relates to the business. So the fact that the business is worth 10 million naira 2 years ago does not mean it's still worth 2 million naira as of today. And that is why we used to have the concept of market value. Market value. It means it can be 2 million naira 3 years ago, but as of today, the worth of the business can be 5 million naira. And that is why you need to value your business. You need to value your business. So valuation of business is the determination of the net worth of a business. And when we talk about net worth of business, we're talking about the equity, that is the business equity, the business equity. So how much is this business worth is a function of business valuation. Now, why do we need to value business? I'll need to get a response. Just look, what circumstance can bring about you valuing your business? What circumstance can bring about business valuation? So why do we value businesses? Can I get a response?
To know the worth of the business or
Okay, to know
worth
the
of
worth of the business.
property of the
That's
business.
one. Okay, that is one. Yes. What are those
For tax
situations?
purposes,
For price purpose. Okay. All right.
Margin and acquisition.
for merger and
Yes. Yes. Because when there is going to be merger and acquisition, this company need to know the worth of what they want to acquire. You don't just sit down and say, okay, let me pay 2 million naira. No, we need to value the asset, the liability. We need to value the asset and the liability of the business. So it is when we value the asset and liability of the business, we can now know the worth of the business that we want to acquire. Then we will now be able to be at par with each other. That is the acquirer and the acquiree. Yes, will now be in tandem. They will now come to a consensus that based on the business valuation, we discover that the worth of your business is 1 million naira. So this is what we pay. So you don't just sit down and say, oh, the value of this business is this. No, you need to put the business to test. So when there is going to be merger and acquisition, there will be need for a business to be valued. There will be need for a business to be valued. What are other circumstances that can warrant business valuation? Business valuation.
For loan facility.
For loan facility,
Loan
yes. You need to get a loan. They will tell you, bring your financial statement. Let's analyze. Let's look at your asset. Let's look at your liability. How well can you quickly pay back? How well can you quickly pay back this loan? So we know the worth of your business before we grant you certain facilities. Certain facilities. Now, some business are not quoted. Why some business are quoted? So we have quoted companies and we have unquoted companies. My question to you is again, when you say quoted companies, unquoted companies, what do we refer to? Quoted companies, unquoted companies. What are we
Hello,
trying to
sir.
say? I can hear you, sir. I can hear you.
I think quoted companies are those companies that their share listed in the stock exchange market.
Yes, very good. While the other one, unquoted,
That their share not listed in the stock exchange market.
was their shares not listed. So when an unquoted company want to go public, it means they want to start issuing out their shares to the public. They want to become public company to be known. There will be need to value their shares. So it is when you value their shares, then you will now know their worth in the open market. So where unquoted companies want to go public, there will be need to value their shares. Now, if you want to know the value of some organizations in Nigeria, you look at their share. What is the market value of their share? Yes, what is the market value of their share? So you don't need to do any serious math because it is made available in the financials. It is made available publicly. So in that case, but for unquoted companies, because they are not public companies, you won't be able to ascertain what the worth of their shares is. So these are some of the reasons that we need to value shares. So you've mentioned that when shares are to be used as collateral, when you want to get a loan and you want to use your share as a collateral, they will need to know what is the value of your shares. So these are some of the reasons why we need to value a business. We need to value a business. So I'm putting it to you so that when you see such, you'll be able to think and write something that is substantial. Because some questions will come. You need to think outside the box and write something good. Yes. So as the question comes theoretically, don't say you've not seen it before. You think and you write. You write something good. So don't just write, but write something good. So the reasons for business valuation mentioned for merger and acquisition, we mentioned for liquidation, and some other reasons can be for tax purpose. Don't you think there will be a need to value a business to know the amount of tax they have to pay? And in terms of estate, so business valuation is required not only to file an estate tax return, but also to provide guidance to the personal representative to fulfill terms of the descendant will. Yes, when someone die and you need to value the estate, there will be need for that for business valuation. And also to avoid conflict and dispute among shareholders, among partnership, where one partner is trying to claim more of an asset over the other, there will be need for valuation. So where there is ownership disputes, this can result into what? Business valuation. Business valuation. And when there is marital dissolution, when there is divorce, there will be need for what? For property valuation. Yes, property valuation. Because in some countries, when a private business owner gets divorced, a valuation may be required to divide what? The marital estate. So whether by agreement of the parties or by a judge. Yes. So this can occur and there will be need to value the business. There will be need to value the business. So these are very important for us to take note. Having said that, please, you can be writing what I'm saying. I don't have them. Let me see. Even though I know I'm fast somehow. But, so now we have various methods of valuing business. We have various methods of valuing business. We have the asset-based approach. We have the market-based approach. We have the income approach. Some authors refer to it as the cash-based approach. Cash-based approach. And by the time we move further to the next level, to the advanced level, there is the free cash flow approach that is in SFM. It is not treated because I have to look at the syllabus to know to use it as my guide. If you look at your study test, you will not see that aspect. But by the time you move to SFM, in fact, it's one of the key things in SFM. Yes, when we talk about base case NPV. So there is free cash flow to equity. Yes, in that at that level. So it's one of the key things that examiners like to ask. But based on the financial management syllabus, I didn't see it there. So I'm just working between the scope of FM. So now, the method of valuing business, we have the asset-based approach, the market-based method, and we have the income approach. When we talk about the asset-based method, under the asset-based method, valuation is usually used as a guide. Is used as a guide in determining the minimum value of a company's net asset. Take note of the word net asset. So in the event of merger and acquisition now, net asset basis cannot be used as a single method of valuation because it may not produce the most realistic value. So using net asset approach, the value of the business or share is calculated as total assets minus what? Total liability. So the formula for net asset is what? What is the formula for net asset? It's total assets less what? Total liability. Less total liability. So as we try to work based on asset-based approach, our focus is to get the net asset. Net asset. The focus is to get the net asset. So the net asset approach, or using the net asset approach, I say the value of the business or share is calculated as what? As total assets minus total liabilities. And the difference between your total assets less liability will give you what? Your net asset. Now, when you get your net asset and you want to know the value of the business per share. In the question, you might not be given the number of shares, but you can be given in your financial position as the value of the whole shares as 1 naira per share. 1 naira per share, but in your financial position, statement of financial position, you have the value of the whole share to be 25 million. So if the whole value of the share is 25 million and it is stated beside that 1 naira per share, if you want to know the number of shares you have in the organization, what will you do? What will you do is you divide 25 million by 1. It means
25 million divided by 1.
it means the number of shares will be what? 25 million ordinary shares. 25 million ordinary shares. So now, if you have your net assets and you want to know the value of one share, is to divide the net assets by the number of ordinary share in issue. It will give you the value of one share in an organization. To give you the value of one share in an organization. So, Faith, what is your question?
Sir, I wanted you to, why you defined the asset-based method as valuation, like under the asset-based method, valuation is usually used as a guide to do, I don't know, I didn't get it, so I wanted you
I
to.
said the asset-based approach, that's this method of valuation. This method of valuation is used as a guide. It's used as a guide in determining the minimum value of a company's net asset. The minimum value of a company's net asset. Net asset. Now, under this asset-based approach, we look at 3 methods. We have the book value approach. We'll look at the replacement value approach, and we'll look at the realizable value approach under the asset-based approach. Now, when we talk about the book value, let me be writing some of these things because I might not have time to write it after this class. So the asset-based approach. The asset-based approach of business valuation. Under it, we'll look at the book value. We'll look at the realizable value. And also we'll look at the replacement value. Now, when we talk about the book value, in financial accounting, we carry the value of our assets based on what concept? The value of assets in your statement of financial position is carried at what? Is stated as what?
And net book value.
Okay. Yeah, it's stated at net book value. Yes. So, but before we get the net book value, we deduct our depreciation. So it is carried at the historical value. So take note, this book value can otherwise be referred to as what? The historical value. The book value is also known as what? Historical value. So it is calculated as a difference between total tangible assets less total liabilities. Take notes. Total tangible assets less what? less total liabilities. Less total liabilities. Less total liabilities. The question I want to ask is, why are we just saying total tangible assets? Why are we not including intangible assets? Yes. Why are we not including intangible assets?
because we
I'm
cannot.
asking some of these questions to make the understanding rest with us. Yes, sir, I'm with you.
Okay, intangible assets are those assets either developed by the company in form of goodwill or human capital development. So it is, we may not really include those intangible assets in our valuation because it's very difficult to get the actual value of goodwill or maybe human capital development. So including it may not really give us a realistic value.
Yes, and that is it. That is just a very good explanation to that question. Now, the examples of intangible assets such as copyright, goodwill are ignored because you cannot determine their market value. But in a question where you are giving the market value, fine. But it is in a very rare situation. So, and that is why we ignore it. You cannot actually determine their market value. The value of copyright by a particular organization, you cannot determine it in the overall market, in the open market. And that is why we are not incorporating it in our calculation. Please take notes so that when I present a question and we are ignoring some elements, I will not get a question. Why are we not including this? I'm saying it now. Maybe those people, their network might have pulled them out now. They'll come back and ask me. So we are ignoring such assets because we cannot really ascertain their market value. So, and that is why we are looking at tangible assets, as the case may be. So this book value, I said, it involves the use of total value of the tangible asset as per the statement of financial position, less liabilities. So intangible assets are excluded where there is no market value for it. Take note of that. Now, how do we compute our market value, or how do we value business using the book value? Let's look at the format. To value a business as book value. We have the format to be in this form. Book value. The format is not something serious as far as I'm concerned. Once you're an accountant, you are used to all what we'll be presenting here. So we said we are looking at the total assets, but not just the total asset, total value of what? The tangible assets. And we can have them classified as what? Non-current assets. Is it just the non-current assets? The book value of the non-current assets. The book value of the non-current asset can have a value for it. We're just trying to show a format. So when we try to solve a question, we'll make life easy for ourselves. So we have it. Non-current assets. we have it, the book value, we have the current assets, the current assets. Still, I'm putting book value so that when we start solving question and I'm saying book value, so the book value, when you add these two elements together, non-current assets plus current assets, you're going to have what?
Total assets.
Future assets.
You're going to have total assets. So we have it in this form. Going to have it as total assets. Now, where are we driving at? We want to get our net assets, which will also serve as our value of equity. So to get our net assets, we're going to less the liabilities. We're going to less our liabilities, total liabilities. Now, when you less your liability, you're going to have it as what? The result will be what?
Net assets.
Net
Which
assets.
which can also serve as what? Also serve as what?
Equity.
Equity. Yes,
Equity.
equity. Equity. So can have a value of equity to be the difference between your total assets and your liability. Now, if this is your value of equity, now the value of equity is associated with who?
Shareholders.
With the shareholders.
Very good. With the shareholders. Now, if you have your value of equity to be 1 million, this is just an assumption so that you not ask me where I'm getting the 1 million from. I'm just assuming now. Let's say our value of equity is 1 million. And you have 500,000 shares. Take note of the word shares. 500,000 shares. If you want to know the value of one share, what will you do? If you want to know the value of one share, what will you do? The value of one share. Value per
500,000.
share.
1 million divided by 500.
1 million divided by 500,000 shares.
Very good. So value per share will be equal to what? Value of equity. Value of equity divided by what? Value of equity divided by number of issued ordinary share, or number of ordinary share. Number of issued ordinary share. Number of issued ordinary share. Take note of all this. So when we start solving questions, you not find yourself elsewhere. The number of ordinary shares. Number of ordinary shares. So this is a method we can use to determine the value of a business. So the value per share can be value of equity divided by number of issued ordinary shares. Now, the other one we're going to look out for is the issue of what? Of the realizable value. Realizable value. How do we compute or value a business using this approach? Realizable value. Realizable value. Now, when we talk about realizable value, what do we refer to? Let's even analyze that word, realizable value. Because we talked about it for those doing PM, talked about that during relevant costing. And some people were asking what is the difference between realizable value disposable value, and the rest of it. So let's analyze. When we talk about realizable value, what are we referring to? Realizable value. Realizable.
Higher of
Is that?
So can I try? I don't know.
Yes, you can try.
Okay, I feel that realizable value is the value that you get after, like, you have disposed the actual amount you get after you have disposed the product, but the disposable value is the actual amount as the actual value of that goods that you're about to dispose. Don't know.
All right. So realizable value is otherwise referred to as what? Net realizable value. For those of you doing FR, you should be very good at this. Realizable value is same as what? Net realizable value. So it's the amount of cash that can be obtained from selling an asset after deducting any cost required to sell or complete it. That's what we call cost to sell when you're dealing with impairment. Impairment in financial reporting. Yes. In financial reporting, we're trying to look at if an asset has been impaired or not. Then you compare the values, the market value, you compare the fair value less cost to sell. So you see if the asset has been impaired. So when we talk about realizable value, is the amount of cash that can be obtained from selling an asset after deducting any cost required to sell or complete it. So if I sell this asset today, how much cash will I actually receive? Please take note of that, of this sentence I just made now, because when we come to a point and we are looking at issues of receivable, receivable means you've given out goods to your customers, but there is possibility of bad debt. So when you see issue of bad debt in a question, it means it is related to what? Realizable value. Realizable value. Because the realizable value is how much will I get now if I'm to collect back my money? If I should meet my debtors, will I recoup back the whole value of my debt? The answer might be no, because some of those that you decided to give your goods to, there might be nowhere to be found. So there's possibility of making provisions for bad debt. And when you're making provision for bad debt, it is linked towards the realizable value. How much will I get now from my receivable? So take notes of this explanation so that when I come to solve a question, I'll not get too much questions. So when you see a question based on business valuation and you're seeing issues of bad debt, it means it is linked to what? Your realizable value. Which aspect of your realizable value? Receivables. 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 So now, realizable value. This is the amount the selling company will realize if the assets are sold on a piecemeal basis. And it is the minimum amount that the target company will be willing and ready to accept from the purchaser of the company. So the value of a business is determined same as book value basis, but the book value of some of the tangible assets are replaced with the realizable value. So just as we've shown, based on the book value, where the question is giving you the realizable value for non-current assets, instead of using the book value, what will you do? You replace the book value with the realizable value. Where a question is giving you realizable value for current assets, what will you do? You replace the current asset book value with what? The realizable value. Another word for realizable value can be what? Can be market value. Can be market value. Can be market value. But please take note. Take note where realizable value is not given to you for some of those assets. What will you do? Where realizable value is not given to you for some of those assets, what will you do? You still use what? The book value. You assume the book value is same as the realizable value. Take note. Take note where you are not giving market value. You are not giving realizable value, for example, for a current asset, for non-current asset. And the question is asking you, using realizable value, what will you do? You still assume the book value is same as the realizable value. Please take note of this. So when I present a question and the question is not giving us realizable value for the whole asset, take note that I've explained that where the realizable value is not given, you still use the book value as the realizable value. Take note of that. Take note of that. So that is that for realizable value. But let's show the format. It's just same as what we've shown before, but let's still show it. Still show it. So we can have realizable value. Realizable value. Under this method, the market estimate. The market estimate is just to reiterate what I've said before. The market estimate of the asset should be used to determine the value of the business. So the format is not far from what we've seen before. The format, we have our non-current assets, non-current assets, non-current assets. At what? Non-current assets at what? At what basis? At market value, based on market value given, or realizable value. So I will not get questioned that what is the difference between realizable value and market value. Let's write it. Market value or realizable value. So now we have it. Have it as this. So the next is our current assets. The current assets still at what? Market value, where it is given. Market value or realizable value. And you add, this will lead you to what? To your total assets. Your total assets. You get your total assets, less your what? Your liabilities. Less your liabilities. Less your liabilities. The difference between your total assets and total liability will give you what? The value of your equity. It give you the value of your equity. value of equity. And the value of equity, as it is being derived, you can also determine the value per share, just as we've shown in the case of book value, where you have the total number of ordinary shares, you have the value of equity, and determine the value per share, and determine the value per share. So this is for realizable value. Hope this is clear, please. Realizable value. So you'll be given the book value in the question, then as a form of additional information, can be given the realizable value. So when you are to use the realizable value approach, you replace the book value figures with the realizable figures given in the question. So we also have another approach known as what? The replacement value. The replacement value. The replacement value. The replacement value is another approach that we can look out for. The replacement value. So this replacement value is the value of the business is the net asset at their current cost of acquisition. The current cost of acquisition in the market, less all liabilities. So it means that this replacement value represents the cost of setting up a similar company, and it is the maximum amount that the acquiring company will pay to the target company in the event of what? Of merger and acquisition. So under this method of replacement method, the value of a business is determined same under the book value. Yes, they are not far from each other, but the historical value of some of the tangible assets are replaced with what? With the replacement value. Still in the question, you'll be given the replacement value. You'll be given the replacement
So you are
value.
fast.
The replacement value, that this represent the cost of setting up similar companies, and it is the maximum amount that the acquiring company will pay to the target company in the event of merger and acquisition. So that's just like we have in the book value. You'll be given the replacement value figures in the question. So what do you do in trying to solve questions using the replacement value? It's just for you to replace the book value given in the question with the replacement value figures given. So this replacement value method, this is a method of establishing a value that is certainly wouldn't make much sense in a service industry where the key assets are the people, and their ideas are hard to value and develop. So using this replacement value, when you are replacing Mr. A and B, Mr. A and B, they are two different personalities. The experience Mr. A has gathered, Mr. B might not have gathered it. So trying to get the worth of Mr. A in the market, you might not be able to get a value or a tangible replacement. So this might not actually be practicable when trying to look at the human personnel, the personnel in an organization. And that is why you see that we ignore that aspect of intangible, the intrinsic values, intrinsic assets in computing our business valuation based on the asset-based method. So things like copyright, goodwill, intellectual properties are excluded because their market value cannot be quantified. So Still same format for replacements as we have for realizable, same format to compute. Let's look at one of the examples I forwarded on the platform. Let's see what they want us to do as far as that example is concerned. One of the examples on the, let's see, I'll quickly, okay, let's run with the one with in our study pack, that the statement of financial position. Let me send it to my system. Somebody can read as I try to forward it to my system. The question from the ICANN study test. I'll solve that one, you solve the other one. Yes, somebody can read.
So is it the one you forwarded to our group?
The question on the group, the one with the ICANN, the one from the ICANN study test. I will be surprised some people don't have it. Some people didn't even check it. So when we start solving, we'll start asking questions.
The statement of financial position of ozone as at 31st type is expected to be as follows. Total asset, non-current assets, net of depreciation, 1,303,200. Current assets, stock and work in progress, 1,031,800. Receivables, 1,490,000. Bank, they have the credit side and the debit side, 316,200 and 2,838,000. Equity and liabilities. Issued ordinary shares at 1 naira each, 100,000. Distributable reserves, 808,200. Shareholders fund, 908,200. Payables, 1,507,200. Bank overdraft, they have the credit and debits. There's 1,725,800 and 3,233,000. So which totals 4,141,200. So
I think that's a subtotal.
is that?
Sorry. I think it's
That's the total
subtotal.
overdraft. Debit and credit.
Okay, yeah. Sorry, it's the total overdraft. You're correct. So the estimated values of Ozone's non-current assets and work in progress as on 31st December 2025 are okay. They have the replacement cost and the realizable value. So non-current assets under the replacement cost, 1,450,000. Under the realizable value, 900,000. The stock and work in progress under cost, 1,100,000. Under the realizable value, 1,140,000. So required, calculate the value of Resume PLC using A, net asset historical method, then B, net asset net realizable value method, then C, net asset replacement value.
All right, thank you very much. So looking at the question that we should solve using the net asset historic method. Another name for net asset historic method is what?
Is net book value.
Value.
Book value.
Book value. Book value. So based on the format we've shown, what are the variables to look out for? What are the variables to look out for? If you are checking
Non-current assets. Non-current assets.
And
Then less
liabilities.
liabilities.
Okay, fine. We are checking the solution in the study part. I'm not following what they are doing there, but at least we'll arrive at the same result. So before you come and tell me,
I'm not
sorry.
checking it. Oh.
No, not you. I'm just speaking on a general note. You know, some people can be following what is in the.
I'm following the formats you discussed.
Yes, I'm not referring to you. I'm not referring to anybody. I'm just speaking on a general note. So now we have this question. So now the book value approach. Looking at this question, we need to determine our non-current assets. The non-current assets is what? The value of non-current assets is what?
1,303,200.
And the value of current assets are what?
1,031,800 plus 1,490,200.
Current assets 2,838,000. That's the total.
So the total assets will now be what? Total assets.
414. 4,414.
Our total liability will be what? Let me know what is happening.
3,233,000.
The total liability is 3,233,000. Payables and bank overdrafts. Payables and bank overdrafts. There are the liabilities. So the difference between 4,141,200 minus 3,233,000 will give you what? Will give us what?
Will give us our equity. The value of equity.
To be what?
I don't have to put that.
908,200.
908,200.
Fine. For those of you that have your study material with you, go and check the result there. Come back and tell me.
11 minus
And
3.
some persons. The value of equity can be 908,200. So if you want to know the value of one share, what will you do? The value of one share, what will you do? Issued ordinary shares at 1 naira each. It means one share is valued at 1 naira each. If you have 100,000 naira, how many shares do you have? 100,000 divided by 1 naira will give you what?
100,000.
So if you want to know the value of one share from your computation here, what will you do?
908,200 divided by 100.
100,000.
So value per share will be what?
9 naira 8 kobo.
Naira 8 kobo, right?
08.
082.
Like this.
Yes, sir.
Yes, sir.
So this is based on the book value. Based on the book value. Has anybody checked the study pack? What is your results from the study pack? What have they done there? On the study pack, you see that they've started with net asset, right? You have access to it. They started with net asset. But to make it very straight, you follow what I've shown to you. So don't go and get yourself confused. This is very straightforward. So now, using the net assets, net realizable value method, net asset, net realizable value method, what are we going to do? What are we going to do? Net asset, net realizable value method. Looking at the question, you have replacement cost, you have realizable value. You have replacement cost and you have realizable value. So what are we going to do at this point? Instead of using the book value of non-current assets, we're going to replace that with what?
Net
900
realizable value.
with 900,000. Instead of using stock and work in progress as given in the question, we're going to use 1,140,000. Since we don't have the value of receivable and bank in terms of realizable value, what are we going to do? We're still going to use the book value.
Net book
We
value.
read it like that.
We're going to use the book value. So now, based on net realizable value, your non-current assets as given in the additional information is what? Is 900,000. Then the value of your stock is what? Given in the question.
1,140,000.
So we have it as non-current assets, non-current assets, non-current assets at net realizable value. Everything is at net realizable value, so there is no need for all this. So we have it as what? 900,000. And the value of stock in the question is what? Additional information.
1,140,000.
1,140,000. We have receivables. We're going to use the book value given to be
490,000.
The bank value, we're going to use the value of 316.
200. 316,200.
So the total assets total assets will be 3
3,846,000.
3,846,200. Now moving to the liability. For the liabilities, we have payables. The payables, the value is what?
1,507,200.
1,507,200. Still also, we have bank overdrafts. We have bank overdrafts. The bank overdraft, the value is what?
4,141,200.
1,725,800.
So when we less our total assets from these liabilities, we're going to have what?
613,200.
Yes. So your value of equity will be what?
613,200.
613,200.
200.
So note this. Let me put notes. Most questions involving net realizable value we tell you that let's say 4% of the receivables 4% of the receivables are irrecoverable. Depending, it can be 20% are irrecoverable. What are you going to do at this point? Because in this question, that statement was omitted. If you go to the study pack, you'll see what they've done. So you'll be wondering where 4% is coming from. You understand? For those of you that have maybe studied this before now, you would have seen that played out. So what happened? That is an omission. So I'm going to show what happened now so that when you go back there, you understand what has played out. So 4% of receivables are irrecoverable. What will be the implication? It means this receivable of 1,490,000, 4% out of it won't be able to get it. It means the value of receivable to the tune of 4% will be deducted. So now 4% of this receivable, 1,490,000 is what? 4% of 1,490,000 is what?
59,600.
59,600. Fine. Let me write it out. 4%. So now, based on realizable value, realizable value means what you will get now. It means this 59,600 is what cannot be obtained now.
It's the bad debt.
So realizable value, it shows real cash value, not accounting value. It shows what? Real cash value, not accounting value, not those book values we carry, but the reality. So in business valuation, when using net realizable value, we adjust for unrealistic values. So unrealistic values are removed, are eliminated when using what? The net realizable value method. So that is why we are going to deduct this value of what? Of 59,600. This value of 59,600 to get the actual value of what is required from our debtors. So when you less 59,600, what, take note, is not in this question, but I'm just bringing it in because when you go to the source of this question, it's supposed to be there, stated clearly, but it's not stated. When you go to the workings, you see it playing out so that you will not spend 30 minutes there. That is why I'm saying it. So now, when you less 59,600 from these 613,200, you're going to have what?
553,600.
Sir,
Yes, what is your question?
okay. I thought we would deduct this 51,600 directly from the receivable. That's the bad debt that will not be recovered from the receivable before adding it to other current assets.
I'm showing this as an additional note because it's not originally stated in the question. So I'm now bringing it in to show us that if you have seen 4% receivables as being irrecoverable, either you deduct it from this point, is fine. Either you come down and deduct it, is fine. Why I didn't deduct it initially? Because it's not stated in the question. So I want to work based on what the question wants us to do. So based on my research, my studies, I discovered this value is supposed to be part of the question, but it's not there. So I'm now telling us that when you go back to study and you are doing your personal study, note that there is 4% irrecoverable value that should be what? Deducted from 1,490,000. So the fact that I'm still recognizing it as a line item here is still very okay. So the only thing, I might not put this as my value of equity for now. Yes, based on the fact that I'm coming up with this. So when you less this from 61,200, what are you going to have as your value of equity? The value of equity is
553,600.
553,600. So when you go to the study pack, you see that this is what the result is. This is what the result is based on net realizable value. I'm saying this because the other question is clearly stated. The other question I put down on paper is clearly stated. So when you go there to solve, know what to do. Know what to do. So the other method they want us to look at is what? The replacement
Value.
the replacement value. The replacement value. Yes, what is the question?
So how do we get the 4%?
It was created now. It's not part of the question. It was created. Just added it.
Are we also going to assume it in exam hall?
Kilode.
I made myself clear before this position.
Maybe
I
network.
I made myself very clear because I know such scenarios will always come up. I I said that the 4% is supposed to be part of the question, but omitted that when you go to the study pack, you will see where 4% is being deducted from what? Receivable. So I'm now saying that let's now work based on what is in the study pack by introducing what? By stating that 4% is what? 4% of receivables are what? Irrecoverable. And that is how we come about this. I stated that when you go to that study pack, you can spend 1 hour on that page because you are looking for why they've treated receivable in that order. So I said receivable is what is based on actual cash, is based on realistic value. So carrying receivable of 1,490,000 in our book is not realistic. That 4% is doubtful. And because this is realizable value, we work based on figures that are realistic. And since it has been stated that 4% is irrecoverable, we less 4% from the receivables to get our value of equity. So in the study pack, when you go there, you will not see that 4%. But I'm not saying that it's supposed to be part of the question, but they solve using 4%. So you'll be wondering, where is this 4% coming from? Because it's not part of the requirement and it's not even reflecting anywhere in the question. So that is why I have to talk about 4% now. So moving to the next one, net asset replacement value. So can you solve? Can you solve based on what we've done now? Can you solve for that? I want to get your answer.
Should we send the answer now?
Yes, solve it in your book, sir, and tell me the answer, sir.
Okay.
Solve it,
Total
solve it.
valuation. Value of equity.
Yes, the value of
One
equity. Yes.
1,124,000.
Okay, you already solved it, sir.
Yes, sir.
Okay, 1,000,000.
124,000.
Okay, okay. I want to get another testifier to validate that result.
I have a question, sir.
Okay, what is your question, sir?
If your statement of financial position is given at cost, then we should be looking out for maybe depreciation and additional information.
Yes, yes, depending on yes. And if it is given at cost, it means still given at what? Historical what? Historical value. Historical value. If you check this question, the question is saying that what? It's saying okay, yes, it's still given at historical value. It means the original value you purchase it. That is the book value. The book value. So if
But
the question is giving you additional information, it will as a way it will come that you will know if you have to make any adjustment to the asset or not. But at cost, it's still at the historical value, sir.
so I was thinking these values we are using are net of depreciation.
As in relation to
This question, this valuation now, since depreciation is more like a fictitious value.
Yes,
So if we are not making use of accounting figures, I was thinking the values we are using here are more of net of depreciation.
that
So now,
is all right. Right on, sir.
if the statement is presented at cost,
Yes.
that is depreciation inclusive, I am thinking maybe we should be looking out for depreciation. I'm thinking.
Okay. If the asset is to be at the carrying value, what do we mean by carrying value? The net book value. The net book value. If asset is to be given at net book value, and you are asked to work based on the book value, the historical value, what are we going to do? Let me come up that way. Let me come up that way. If you are giving the value of your asset as your net book value, what are we going to do? What are we going to do? Net book value. What will be the treatment? What will be the treatment? So the point is this: the depreciation will come in depending on the valuation method you want to adopt. In this historic method, in this historic method, depreciation is already included. So assets are shown net of depreciation. I don't know if that's clear your question, sir.
Yes.
Assets are shown net of depreciation. So you don't need to do anything extra. You don't need to do anything extra. So the non-current assets are already after depreciation, sir, at the book value. Hope that is clear, sir.
Okay.
All right, sir. So, so what is the result, please?
1,120,000.
1,123,200.
1,123,200.
Ma, what is the question, ma? Madam Victoria, what is your question? Okay. So the result is 1,123,200. 1,123,200. Any question about this, please, before we take it further? Any question? Ma, I can see your hand up. Okay. Is it still up? Okay. The other question I forwarded
Hello,
to,
sir. A
I can hear
question,
you.
please. Sir, we did not use the 4% for the irrecoverable debt for this last one. Was he ignored?
Irrecoverable debt is only associated with which form of uh, asset method? Only associated with what? Realizable value. Realizable value. Realizable value. I stated that realizable value is based on realistic figures. Realistic figures. So we are not considering that using the book value. We are not considering that using the replacement value is only associated with the realizable value. So Adiza, what is your question?
Sir, please, can you go back to the solution page? All right, thank you.
So now, the other question I put forward to the class, I will not solve it here. You go and solve it. That the statement of financial position of Temitope PLC as at 31st December 2020 is as follows. That the non-current assets 600,000, current assets we have inventories, receivables, bank balance, and so on. So you go and solve that one and then forward your solution to me. So let's take it further to the other approach that we can use to value a business. The other approach we can use to value a business. So let's see what the other method entails. What the other method entails. We have the income-based approach. That is the income-based approach. Now, under the income-based approach, we'll be looking at the price-earning ratio. Price-earning ratio. Price-earning ratio. When we talk about price-earning ratio, what do we refer to? Price-earning ratio. This income approach can otherwise be referred to as earning basis method. Earning basis method. Earning basis method. Now, in all these approach, what are we trying to ascertain? We're trying to ascertain the market value of the business. The market value of the business. So this income-based approach is a method that is used where we have quite a number of shares involved. And under it, we have price earning ratio. And what is this price earning ratio? What is price earning ratio? My attention will be on those writing FR. For those that have passed FR, I know that might have forgotten if they are not using it day to day. So for those that are writing the FR exam, can you tell me? I know some of you. So can you tell me what price earning ratio is? At least it's a revision now. To be like a revision to you. So what is price earning ratio? Price. Break it down. Price earning ratio. All right. So price earning ratio, these represents the ratio of share price to earning per share. To earning per share. So the price earning ratio is used to value companies with an established profitable history where you have a trend. So this method is used to achieve valuations for quoted companies. When you are using this method, it means you must be able to determine certain variables in the question regarding the company you want to value in terms of their shares, in terms of their earnings over time, and the rest of it. And if you look at most financial statements, you see these variables, EPS. You see it playing out in their financial statements. So you can use that to value the business and run a trend analysis for the past and see where the business is as of today. So price earning ratio can be used to value unquoted business as well. Can be used to value unquoted business as well. So the question is, what is the formula to determine your price earning ratio? What is the formula to determine your price earning ratio? The formula to determine your price earning ratio is what? Formula to determine price earning ratio.
Earning per share
I
over.
know it's market value to earnings per share. I don't know whether it's division or multiplication.
Market price per share over any per share.
Okay. It is fine. Let me see if I don't have it here. All right. So let's write it. Let's write. So the income-based approach. Income-based approach. Number one, we have the price earning ratio. Price earning ratio. Price earning ratio. Price earning ratio. Our formula is equal to is formula is equal to market price divide by earnings. Divide by earnings. In some, that is looking at it holistically now. Holistically, that is divided by earnings. If you want to look at it based on units, it can be earning per share. It can be earning per share. But we are looking at it overall. So market price divided by earnings will give you your price earning ratio. These earnings can also be in form of profit. Can be in form of profit. Now, in trying to determine the value of a business, the value of a business can be determined by what? Looking at this formula here. If you want to know the value of Dangote, through which metrics will you know the value of Dangote? Through which metrics? Is it through the earnings? Is it through the market price?
Market price. Sorry.
So, in most questions, we ask you to determine what? The market price. The market price. So, for you to determine the market price, what are you going to do? What are we going to do now? You make the market price.
Cross multiply. You make market price subject of the formula.
Yes, you make market price subject of the formula. So your market price will now be what? Will now be what? Equal to what? The price earning ratio.
Any per ratio. Multiply by earnings.
Multiply by earnings. Take note of this. Multiply by earnings. The major thing is know the original formula. So when the question is now coming in a way, what you just need to do is to write the original formula and make the value of the unknown the subject of the formula. Make the value of the unknown the subject of the formula. For example, let's write down this example. Let's write down this example that example. So these are ways to value businesses. PE ratio. You can say the earning per share, that is the EPS. The EPS of a private company. Of a private company. ABC ABC company was 15 naira last year. It's 15 naira last year. And is expected to rise to 18 naira. Expected to rise to 18 naira next year. Similar companies whose shares are quoted on the stock market value, on the stock market, have price earning ratios ranging from 10 to 15.6. The average PE ratio, of these companies is 12.5. Looking at this question, for us to determine the market value of ABC company, what are we going to do? For us to determine the market value of ABC, in the question, do you have your earning per share? Do you have your earnings? Look at the
Yes,
question.
sir.
What is your earning?
12.5, right?
Your earnings.
18 naira.
Is
It's
that
18 naira, sir.
18 naira?
18 naira.
Your earnings is
It was
equal
15
to
naira last year and expected to rise to 18 naira.
18 naira. The PE ratio, price earning ratio, is what?
12.5.
PE ratio, we have it as 12.5. So based on these values, can you determine the market price per share?
Yes, sir. We multiply it by each other.
So the market value will be what? Will be 18 multiplied by what? 12.5.
The answer is
225.
22.5.
So we have it as 225 per share. 225 per share. This is based on the price earning ratio method. Price earning ratio. What I want you to understand is this formula. So as you understand this formula, you read the questions, you'll be able to pick out the variables and substitute as appropriate. So now, this is price earning ratio. We have the earning yield. The earning yield approach. The earning yield. And when we talk about the earning yield, this represents the present value of expected future earnings. The present value of expected future earnings. And this present value, whenever we talk about present value, what should come to your mind? It involves discounting. Yes,
Discounting.
it involves discounting. It involves discounting. So the concept is you can have a two-way approach when you are looking at earning yield. When you are looking at earning yield, you can have a situation whereby there is a growth where the earning will grow. You can have a situation where the earning will remain constant. So under the earning yield, we have a scenario where the market value is growing. You can have a case where the market value is constant. So what are we going to do at this point? Basically, what is the formula for earning yield? What is the formula for earning yield?
EPS over market price per share times 100.
Okay, so we have it as earning yield. Earning yield. We can have it as this equal to, when you look at it overall, to the earnings, that is overall earnings divided by what? Divided by market value. Market value. When you are looking at it based on individual shares, it can be earning per share divided by what?
Market
Per
price
share.
per share.
So we can have it in this order. So depending, the question might not give you per, they might give you in total. So the question is this: if you want to determine the market value, what are you going to do? If you want to determine the market value based on this, what are we going to do? If you want to determine the market value,
You make
what are you
market
going
value the subject of the formula.
to make the market value the subject of the formula? And when you make market value the subject of the formula, to now be what? Market value will be,
Earnings multiply earnings per year.
so we now have it as, we now have it as earnings,
Multiply earnings.
earnings divided by earnings yield. I've already jumped one of the steps. So I've jumped one of the steps. So you can do it in your book if you are still trying to get to term to. So instead of doing, I've done cross multiplication in my own mind. So you can do it in your own book practically. You can write it, any yield multiplied by market value is equal to earnings. Then you want to get market value, you divide both sides by what? Any yield. Then any yield cancel any yield. It will now remain only market value. Then any yield will now come under earnings. So you can write it in your book clearly. Me, I've done it in my own mind. Because I've been showing the step over time, so I decided not to show it again. So that at least practice and see if you know how to do subject of the formula. So, or if you still want me to show it, you can raise up your hand. Let me know. You can raise up your hand. I will now know that. Okay, so now this formula can be used where there is no growth. Where there is no growth. Where you have a constant value. Where you have a constant value as your earning. But where there is growth in earnings, what are we going to do? When there is growth in earning, what are we going to do? When there is growth in earning, what are we going to do? The formula is going to be market value will be equal to your earnings into the bracket of what? 1 plus G. You remember our cost of capital, dividend growth model. 1 minus G divided by where there is growth. Divide by what? Your earnings, your earning yield. Your earning yield can be rate of return, can be cost of capital. Take note of that. Your earning yield can be rate of return, can be cost of capital. So it will now be your earnings. Let me still represent it as E, but sometimes it can be what? No, since I have E, let me represent it as R minus G. So I'll define what each of these variables connotes, and what is my E? My E is my expected future earnings. My expected future earnings. And what is my G? My G is growth rate. My G is growth rate, and my R is rates of return. Rate of return. My R is rate of return. So in some questions, your earnings will be profit after tax. Profit after tax. I will not be given to you clearly as earnings. So they can use different terms to represent that. So we can have a question in this form. We can have a question in this form. Let's take a simple example. An example to show. An example to show. We can say the earnings of Kickstarts. The earnings of Kickstarts, a private company. A private company where 450,000 naira last year. Stock market companies in the same industry, provide an earnings yield of about 9%. To their shareholders. 9% to their shareholders. Required using the earnings yield method. of valuation suggests a suitable valuation for the equity shares in Kickstarts. So based on this question, what are we going to do? Valuation of equity. So what are we going to do? What is our formula?
Then it will be 0.0, okay, 9% equal to 450. That's earnings over market price. That's 450 over comma or X.
Our earning yields from the question. That's the earnings of Kickstart, a private company, were 450 last year. The stock market companies in the same industry provide an earnings yield of about 9% to their shareholders. Using the earning yield method of valuation suggests a suitable valuation for the equity shares in Kickstart. Our formula is what?
That's earning yield equals to earnings over market value.
Our formula is, because the question wants us to determine what? The question wants us to determine the value, suitable valuation for the equity. When you talk about value, you're talking about market value, the market value. So it will be for us to
Okay,
get.
it will be earnings over earnings yield.
So for us to get our market value, the earnings in the question is what? Is 450.
450,000.
Now, from the question, I mentioned that any yield can otherwise be referred to as what? Rate of return or cost of capital. And from the question, the rates given to us
It's
based on
9%.
stock markets, based on those in same industry, is 9%. So the market value will be what? Will be 450 divided by 9%.
It's 5
450
million.
divided by 9%. So the outcome when you do that will be 5 million. So that is what the question wants you to do. That is what the question wants you to determine. We have it as 5 million. We have it as 5 million there. We have another approach, which is the dividend yield. Dividend yield. Dividend yield. The dividend yield. Dividend yield. Dividend yield. This method values a business the dividend yield. This method values a business as the ratio of dividend to dividend yield. the ratio of dividend that is, for you to get the market value, you must first establish what is our dividend yield formula. What is our dividend yield formula? If you want to get dividend yield, the,
Annual dividend over current market price.
dividend yield would be it can be overall, it can be total dividend divided by the total market value. Total market value. It can be in this form, or it can be in this form. We are looking at it as single components, and the dividend per share divided by the market price per share. Market price per share. That is the formula to get your dividend yield. Now, from this formula, if you want to get your market value, what are you going to do based on the approach I do show? You make the
Make
market
value the subject of the form.
you make the market value, which is market price per share, the subject of the formula. And when you do that, what will be the outcome? What will be the outcome?
Total dividend over dividend yield.
So in simple terms, you can just have it as this way. Market value will be dividend all over what? Let's say dividend yield can be the same as what? As return. Yes, in simple terms, dividend yield can be same as return. So instead of writing it in full. So still, under this approach, you can have a case, you can have a situation where your dividend is growing and where your dividend is not growing. So where your dividend is growing, our formula will be what? Where your dividend is growing with growth in dividend. Where dividend is not growing, this original formula will stand, will suffice. This will come, but with growth in dividend, with growth in dividend, with growth in dividend, where dividend is growing, they can say dividend will grow at the rate of 2%, 3% in that order. So where dividend is growing, your market value will be equal to what?
D bracket 1 plus G.
Be equal to your dividend 1 plus G, and you have it as your return less the growth. Return less the growth. This is where the question is stated that there will be growth in dividend. If you recall back where we were treating cost of capital, the part 1, when we started, where we look at cost of equity, cost of debt, cost of irredeemable debt, all those concepts is still what is applicable here. All those concepts is still what is applicable. I believe if you watch the video I asked you to watch, you discover I said in that video, I will not treat this part as I did last time, because most of what in some aspects of this topic is what we've treated when we're treating market value. Yes, but in that cost of debt, cost of equity, cost of preference share, but it's same formula, just for you to make Sort of the formula given in cost of capital, and interchange it and get your market value So under the earning basis or income basis, we have the price earning ratio, the earning yield, the dividend yield. So what you need to do is for you to know how to play with the formulas, So also we have the dividend valuation method. Dividend valuation method is not far-fetched from what we've also discussed under the cost of capital. The dividend valuation method. The dividend valuation model is a more objective and cash-based approach to the valuation of shares. The valuation model without growth, and we can have the dividend valuation with growth. Now, when we have dividend, let's write it. Dividend-based valuation method. Dividend-based valuation method. Dividend-based valuation method. We can have a case where the dividend is growing and where the dividend is not growing. So where the dividend is growing, what are we going to do? Where the dividend is growing, what are we going to do? It's still same with what we have. In this case, I will not show it intensively. I'll just go straight where we have a dividend without growth. That is dividend valuation without growth. Dividend valuation without growth. What will happen? Dividend valuation without growth. Without growth. The formula will be what? Will be your market value equal to what? Equal to your dividend divided by what? Divided by your return or your cost of capital. Divided by your return or your cost of capital. That is where there is no growth. Where there is no growth. Where there is no growth. Anyway, I'll finish this tonight. After this example, I'll go straight to one of the concepts I want us to look out for. I'll go straight to one of the concepts. I'm spending much time now. So now, let's look at this question to refresh our brain. Let's look at this example as it relates to that. Let's look at this example that a company is expected to pay an annual dividend. An annual dividend for 8 naira per share. 8 naira per share. Into the foreseeable future. Into the foreseeable future. And the shareholders cost of capital. The shareholder cost of capital. Shareholder cost of capital is 12%. It's 12%. The most recent annual dividend the most recent annual dividend has just been paid. If you recall your cost of capital, you remember where dividend is yet to be paid. What are you going to do to determine your market value? To know you have to less. Or where dividend has been paid, you have to use your market value in that order. Has just been paid. Dividend has just been paid. Question is required. Required. A, using the dividend valuation model. Using the dividend valuation model. Using the dividend valuation model suggests what's the value, suggests what the value, suggests what the value of the shares, what the value of the shares would be, B, show B, show how this valuation, show how this valuation would change, if expected annual dividend, if expected annual dividend in future years, is 54 naira. It's 54 naira. Begin to solve. The formula is on the screen. So before I finish typing, you should give me my answer. Show how this valuation, would change. Show how this valuation would change if the expected annual dividend, in future years is 48 naira. But the cost of equity, capital, is 12.5%. 12.5%. So for A, what would be our answer?
400. B, 450.
Okay. And for C, so for A, this is it. It's not something serious, but the way I was writing it, some people would think it's one serious thing. The formula is what? Market value, dividend divided by return. A, that using the dividend valuation model suggests what the value of the shares would be. That is, if dividend is 48 and your shareholders' cost of capital is what? 12%. It's just to say that what? That's 48 divided by what? Divided by 0.12. And you're going to have the market value to be what? To be 400. And for B, it will be what? For B, states that show how this will change if expected annual dividend in future is what? Is 54. It means your dividend has changed from 48 to what? To 54. So 54 divided by what? What is still the rate of return is still 0.12 because there's no any information that it has changed. So what will be your result? The result will be 450. And for C, it will be what? For C,
384. I don't know.
it will be that the question says that what show how this valuation will change if the expected annual dividend in the future is what? Is 48. Okay, my dividend is 48 and and the equity capital is 12.5%. So it will be 48 naira divided by 0.125, and that will give us 384. 384. So this is what the question actually wants you to do. So when you see this, you should work as expected. Some questions will come because the exam will be a balanced exams. Yes, it will be a balanced exams. So if you follow these classes very well, there will be no any points to, or where there is a topic that is not clear, go back to it and be clear with it. We'll try our best to see how we can make most of these things easy so that there will not be much issues. So the other part I want us to look at is the issue of enterprise value stroke EBITDA. Enterprise value stroke EBITDA. When you talk about EBITDA, it's just an acronym for earnings before interest, tax, depreciation, and what? And amortization. So it's just a short form to refer to earnings before interest, tax, and amortization. Let me see. Okay. Yes, enterprise value. Enterprise value. It's very important. I'm so much interested in this. The enterprise value. Enterprise value. When we talk about enterprise value, enterprise value is the total market value of the business. That is representing the cost of acquiring the entire company, including both equity and debt. Please underline that. Equity and debt. Equity and debt. That is, enterprise value is the total market value of a business representing the cost of acquiring the entire company, including what? Both equity and debt. It's in simple form, I'll say, how much will it cost to buy the whole business? How much will it cost to buy the whole business? So when we talk about enterprise value is what? Is the market value of equity plus market value of debt. Write that in your book. When I go to a question, you see that playing out. Enterprise value, EV, just EV. Enterprise value is different from enterprise value multiple. So you can even see that already. You can see that already on the screen. So enterprise value is market value of equity plus market value of debt, less cash, where cash is given in the question, where cash is part of the element given in the question. But where it is not given, it is just market value of equity plus market value of debt. Market value of debt. So the concept about enterprise value is that it reflects the true value of the business operation, not just shareholders' portion. If you look at what we've been treating over time, we've been looking at equity. But now, in the case of enterprise value, we are looking at the overall component of finance of a business. That is both equity value and what? And the market and the debt value of the business. The debt value of the business. So equity value represent what? The value of shareholders. The value of shareholders. But now, talking about enterprise value, we're talking about the value of the entire business as a whole, which entails equity and debt. Equity and debt. That is enterprise value. If you go to your study pack, you'll see it is defined that enterprise value is a measure of a company's total value, often used as an alternative to market capitalization. As an alternative to market capitalization. So this enterprise value, how do we determine enterprise value? I've stated it. Market value of equity plus market value of debt minus cash. Now, talking about enterprise value multiple. What is this enterprise value multiple? Enterprise value multiple. This enterprise value multiple is just like a standard when you're trying to compare two or more organizations. When you're trying to compare two or more organizations, you look at what their enterprise value is. The enterprise value of one can be used as a basis to determine the other. So this enterprise value multiple, the enterprise value multiple is a valuation ratio. Take note, is a valuation what? Ratio that compares the total value of a business, the total value of a business to measure of its earnings. You can see that in the formula already. It compares the total value of a business to a measure of its earnings. That is the earnings we are referring to is EBITDA. Is EBITDA. So, in simple terms, it is how much are investors paying for each 1 naira of the company's earnings. How much are investors paying for each 1 naira of the company's earnings? So the point is, when you get your enterprise value multiple, your results, if your answer is 6, it will be 6x. If it is 7, it will be 7x. That is just x. So you can use that as a basis to compare another business. To compare another business. So, for example, if your answer is 6, it means investors are willing to pay 6 naira for every 1 naira of EBITDA. Please understand the interpretation. It means if I should determine my enterprise value and determine my EBITDA and discover that in dividing my enterprise value with EBITDA, my result is 6. The interpretation will be that investors are willing to pay what? 6 naira for every value of my earnings. For every value, for every 1 naira of my earnings. For every 1 naira of EBITDA, the investors are willing to pay 6 naira. So, how do we determine EBITDA? How do we determine enterprise value? Let's save time by using a question to show that. This is a question. This is one of the questions I discussed in one of the video I refer you to that I was talking about in that video, but I decided not to send the video. I want us to look at it together in the class. So looking at this example, I want to treat this example because when you go to your study pack and you are doing your personal studies, there might be a need for certain explanation. That is why I'm particular about this, to simplify certain things. So when you go back there, you get it very easy. So now, looking at this question, we have two companies. We have the following information, financial information is available for Aka Limited. All figures are in million. We have 2 years. the historic, the past, 2020, the forecast, 2021. You have revenue, operating profit, you have depreciation, you have amortization, you have net asset value, you have book value of bonds, currently trading at 80 naira. The closest comparable company to Aka Limited has been identified as its competitor, Kemi PLC, for which you have been able to ascertain the following data. Now, in Kemi, we have revenue, we have operating profit, depreciation, we have amortization, we have the net asset value, and we have book value of bonds currently trading at 125 naira. Today's share price for Kemi PLC is what? 175 kobo. Kemi has how many shares? 27,300,000 shares in issue. Use the information to derive the equity value for Aka Limited based on an EBITDA multiple. Now, looking at this question, Aka Limited is an unquoted company. Looking at the question, Aka Limited is an unquoted company. So we want to compare Aka Limited with Kemi. Kemi is quoted. Why is Kemi quoted? Who can look at the values? Can you look at the values in this question and tell me why Kemi is quoted?
The public limited liability company.
Okay, that is PLC, public limited. Okay, aside that, what other thing shows that Kemi is quoted?
The share price was stated in the question.
Very good. The share price. So why are we comparing Aka Limited with Kemi PLC? Because Aka Limited is not listed. No share price, no market value, and cannot directly calculate its value. So what do? We use a similar company, Kemi PLC, as a benchmark. So what is the basis of comparison? The basis of comparison is that the closest comparable company to Aka Limited is Kemi PLC. That means they are in similar industry, and they have similar business operation, the risk level similar, and the growth prospects of Aka Limited is in line with that of Kemi. So if two companies are similar, investors should value them in similar manner. So, and that is why the question is bringing up it in this form, to compare both. So the first thing to do, let's ask ourselves, what is the equity value of Kemi? What is the equity value of Kemi? The equity value of Kemi. Number one, what is the share price of Kemi?
175.
Yes, the share price of Kemi is 1 naira 75 kobo. 1 naira 75 kobo. The question now is, how many shares can we attribute to Kemi? Kemi is having how many shares? Kemi is having 27,300,000 shares. So if Kemi is having 27,300,000 shares, what is the value of these 27,300,000 shares in naira? The value
Is 156,000.
So that's right. Share price. The solution is on this page already, but is in the study pack. This is it, but let me break it down so that we will not have issues when you go there. You might not see it in this form. The share price is 1 naira 75. The number of shares is I'll just make it brief, 27.3 million. Now the equity value will be equal to what? 1.75 multiplied by 27.3, and the value will be what? The value will be 47.8 million. 47.8 million. That is the equity value of Kemi. That is the equity value of Kemi.
Sir,
Hope this
sorry,
is
is it 1.75 or 175 kobo?
175 kobo is same as 1 naira 75 kobo.
Okay, sir. Thank you, sir.
So because these values are stated in naira, so you need to convert this 175 kobo in form of naira to make it match, and that is why we have to say 1 naira 75 kobo. So what will be the market value of debt? That is where I'm most concerned about. The market value of debt of Kemi will be what? Book value of bonds. This is debt. Currently trading at 1 naira, 125 naira. So the book value is what? 20 million. So if it is currently trading at 125, what will be the value of our debts? Can anybody speak to this? What will be the value of our debt?
2,500,000,000.
Value of our debts. All right, the value of our debt is this. Let's show it. Value of debts. Value of debts. Value of debts. Now, debt, the nominal value of debt is what? The nominal value of
125.
125.
125.
I need to, yes, Madam Rose, can you tell me what is the value of debt? Nominal value of debt.
Okay. So
100.
I was hearing your voice on the ground. That is why I have to call you. So that I don't want Kuro's answer. So when I pick you out, you speak for yourself.
okay.
But don't worry, they're giving me my answer. 100. 100.
Yes.
Yes. This is just like a reflection, a revision back to the issue of cost of
Cost
capital.
capital. Yes.
Cost of capital. So the nominal value of debt, they will not tell you is 100, or where stated it can be 1,000. So the nominal value of debt is 100.
Okay.
100. The nominal value of debt is 100. Now, if the nominal value of debt is 100 and your book value is 20 million, how many shares do you have, or how many debts, loan notes do you have in 20 million? How many loan notes do you have in 20 million? This is the key point I want to explain in this question, because when you go to the study pack, it's not explained. So you'll be asking yourself, where did they get these results? And that is why I'm so keen about this, to explain this part. So if the nominal value of debt is 100, and in your book, the book value of debt is 20 million, how many loan notes, how many debt do you have in 20 million?
200,000.
200,000.
So 200,000 multiplied by 125 will give you the current market value.
25 million.
Fine. That is just the result. That is just what I want to establish. So now, the market value of debt would be, let me do it this way, 20 million divided by 100, multiply by what? Multiply by 125. Multiply by 125. Some authors will do it this way. Instead of putting the 100 here, they'll put it under 125. It's the same, you have same results. You have some, but for clear understanding, I like to present it this way. So that student will not come and ask me, why are you bringing 100 under 125? I'm putting 100 under 20 million because when you divide 20 million by 100, you have the number of what? Loan notes in 20 million. Then when you multiply that by 125, you get the current market value of the debt. And that is why I'm doing it this way. So when you go to your book and you see them putting 100 under 125, they are also correct. They are correct. So, but I don't want somebody to come and ask me, why is 100 under 125? That is why I'm presenting my own this way. So that with this now, you know why 100 is under 20 million. You know why. So that is why I have to present it that way. So when you divide, you have 25 million. You have 25 million. You have 25 million. Now, we define enterprise value to be what? Can somebody recall? We define enterprise value to be what?
Market value of equity minus debt. Plus debt minus cash.
Very good. Very good. Very good. So in this question, we don't have issue of cash. So what will be our EV? What will be our enterprise value?
Equity plus debt.
Very good. Your enterprise value will be what? Enterprise value, that is EV, will be equal to 47.8 plus what? 27,
24.
25. And this will give you what?
70, 73.
$72.8 or 73.
72.8 million. 72.8 million. 72.8 million. Now, when we talk about EBITDA, when we talk about earning before interest, tax, depreciation, and amortization, what are we referring to? All we are doing, we are working based on Kemi now. We want to calculate Kemi EBITDA multiple. We want to calculate, so we are using Kemi's figures. Kemi EBITDA multiples. Now, we've been able to establish the enterprise value. Let me go back to the formula. Let's go back to the formula. The enterprise value, it means we've derived what? This numerator, right? Enterprise value. Now, what would be your EBITDA? What would be your earnings before interest, tax, and depreciation? What would be your EBITDA? From
That
the
should be
question.
operating profit.
Okay. Earning before interest, tax, so So you said operating profits.
Yes, sir.
Operating profits. Earnings before interest, tax, depreciation. So everybody is agreeing that is operating profits. You are all agreeing to the fact that is operating profit. Okay. Operating profits. When we talk about earnings before interest, tax, depreciation, and amortization, anything that is non-cash will be added back. Will be added back to your operating profit. Anything that is what? That is non-cash. This depreciation, this amortization, they are non-cash items. So we need to add back issue of depreciation and amortization back to our back to determine our earnings before interest, depreciation, and amortization. Is this strange?
It is so. It is, sir.
So why is it strange, sir?
I'm looking at operating profit to be a kind of gross profit. That is before the depreciation and all that will come in. I'm
Okay.
thinking when you have to add back is where you are giving net profit.
Sorry, 1 minute. No, the operating profit. Before then, what is the definition of operating profit? That is where you are going to answer your question. What is the definition of operating profit? Yes. What is the definition of operating profit?
This should be profit after cost of sales. That is revenue minus cost of sales.
Gross profits.
Okay, that is your operating profit. That is not your operating profit. That is not the operating profit. The operating profit is the profit after you've deducted everything that has to do with the operation of the business. Please, just 1 minute. Let me pick a call. Just a few minutes. Let me end the recordings of Apex class. So operating profits. At what point do you less every expenses that has to do with your operation? Let's go elementary now. At what point in your financial statement, do you less all those expenses that has to do with your operation?
When we are to determine our net profit,
So after you've deducted all those operating uh, activities, expenses, the profit you determine will now be termed as what?
net profit,
Another word for net profit is what?
operating profit.
So I'm now surprised because I want to get confused with your analogy of what operating profit is. So, my Oga, another word for net profit is operating profit, please. So that is why we need to add back those values. We need to add back those values of depreciation and amortization. I don't know.
Okay,
Are
sir.
you still there? Are
I'm
you there,
with
sir?
you.
Uh-huh.
Yes, sir.
So the depreciation, it reduces what? The accounting profit, but it does not involve any cash flow. It does not involve any cash flow. So this operating profit, the operating profit that is earning before interest and tax, should include what? Should include our depreciation. We should add it back because this EBIT that we're trying to achieve measures pure operating performance before what? Before non-cash charges. So what it does is that for us to determine our EBITDA, we need to add back the depreciation because it is what? It is a non-cash expense. It is just an accounting allocation of asset cost. So adding back the depreciation and amortization will actually help us to determine the actual earnings before all those non-cash expense. Non-cash expense. So the issue of depreciation does not enable cash to leave the business. So to determine our EBITDA, our earnings before interest, tax, depreciation, and amortization, it is our operating profit plus what? Depreciation plus amortization. So depreciation is added back because it does not represent what? Real cash cost. So, and that is why we need to add it back. So because this has to do with investment, and what investors are concerned about, they are concerned about how well a business can generate cash. That is the cash generating ability of a business. So the issue of EBITDA removes those accounting concepts, accounting policies, and add them back and add them back. You know, depreciation is an accounting policy that you just determine and estimate in order to account for the life of the asset. But these on investors concept, you add them back. They want to see how well you can generate cash because removing that depreciation will reduce your overall earnings. So you add them back. Let's see what you actually earn. So that is it, sir. Hope that is clear, sir. So
Yes, sir.
now, all right. So now, based on our formula, EBITDA. Sorry, I'll round up now. Taking your time. I just want to see that the enterprise value we've determined is 72.8, right? So what will be our EBITDA? We have 2 years. Our EBITDA, operating profit in 2020 is what? 10. Isn't it? Add back your
It is,
amortization.
sir.
Add
Yes.
back your amortization, 2.2.
Only
So when you
12.2.
so 72.8 divided by what? 12.2. You have what?
6x approximately.
Very good. So now for I will not show my workings again. The major point I need to show, I've shown it. So you can refer to your study pack for any other explanation. Now for 2021, what will be your the value of what? Of your EBITDA. The value of your EBITDA will be what? For 2021. Going through the question. 12.6 plus what? 2.2. 12.6 plus what? 2.2. And we are going to have what? 14.8. When you divide 72.8 by 14.8, what will be your EBITDA multiples?
4.9.
Okay, 4.9. Your EBITDA multiples will be 4.9. 4.9. So that's those results you have. You can now use it in relation to what? To Aka Limited. You can now use it in relation to Aka Limited. Now, for Aka Limited, if you want to value Aka Limited based on EBITDA, what will you do? What will you do? What is their operating profit? Or what is their EBITDA? What is Aka's EBITDA for 2020? 8.7 plus 0.5 plus 0.3. We give you what?
9.5.
9.5. So in relation to that 6 points you have in 2020 as EBITDA multiples is a way that we can compare how much investors are willing to pay for every earnings of Kemi. So if they are willing to pay 6 naira for every 1 naira Kemi earns, how much will they pay overall for Aka? If Aka is getting 9.5 million, how much will investor pay overall? So we are trying to compare Kemi's results in relation to Aka. So if Kemi is getting 6.0 for every 1 naira of its earnings, and Aka is making 9.5 million as its overall earnings, how much will be overall EBITDA for Aka? It will be 6.0 multiplied by 9.5. In 2021, what is the EBITDA of Aka? That is 9.2 plus 0.6 plus 0.3, right? And this will give you what?
10.1.
Multiply by 4.9 that you have for Kemi in 2021. And that will give you what?
49.49.
49.49. So that is the major thing I want to show as far as the question is concerned. The analysis are in the study test. This is the study test screenshots I added to my slide. You can visit. This is in when I was teaching SFM, and it's also in financial management. So most of the things in that, some topics in SFM, they just copy added directly to financial management. So you can go back to the study tests and analyze the results very clearly. So the major silent issues in the question is what I've decided to show us, so that you will not go and spend hours trying to see figures. And that is what I want to achieve. So thank you very much for coming
Thank you,
here.
sir.
Thank you, sir.
Thank
Sir,
you,
I
sir.
wanted to ask something. I don't know.